Okay, let's see. Okay, so the objective of today is to share tips of how we can stay afloat in achieving our financial freedom with the increase in interest rates. So that's all what we're gonna be talking about. Like, how can we like just stay afloat? Like, how can we be like on top of with our finances? Because we know, especially in South Africa, interest rates have been increasing like crazy since last year. So now let's look at how many times have these interest rates have increased since last year. If you look, I just put this data from Google, and if you look from January 2022, this is the how the interest rates have increased in South Africa since January 2022 last year. We had have repo rates increased 9 times since 2022. So you can just see like it's been so crazy, like the way they're increasing the interest rates. But however, the guys from the Reserve Bank, they said that when they increase the interest rates, they're trying to manage inflation. But I don't know if it's also true to when it comes to our personal finances. I think that also plays a different ballgame when it comes to our personal finances. So if we add all the bits and pieces of the 25 basis, 50 basis they've been adding, we have an impact of 4.25%, which has increased on interest rates. So if we, okay, these are just the numbers we are looking at. What impact does it have on our money? So I'm going to share this in two different scenarios, like this impact of increases in interest rates, like how does it impact the money? Like, let's say maybe you're in debt, like maybe you've got mortgages, you got a vehicle, whatever it is. The increase in interest rates, how does it impact your debt? So this is the honest truth. Each time when interest rates increases, it impacts you on the installments you pay on your debt, because whenever they increase the interest rates, which means they also increase the interest rates of the loan you have taken, of or whatever the borrowing you have taken, because that's how the banks and they make money. So whenever, like maybe let's say maybe you took out a loan and the interest rate was on 10%. But now, because we've got that impact of the 4.25%, which means your interest rate is increased to 14.25%, which means you're now paying more installments, which also will increase the principal of the whole amount you are going to be paying for your debt, which is not a good sign. Which is not a good thing to your money. But as we're gonna go through it, I'll also give examples. Like maybe if you had if you had a debt on car finance, or if you had a debt on mortgage, I'll give those scenarios. So that's the impact it will have also on your debt. That high interest rates mean that also you also have high interest charges. You also have high interest charges, which is also going to affect your installments and the big and the whole installment you are going to be paying for that money on your on your loan or on your borrowing, whatever it is. And okay, let's move on to, like, okay, let's say when we're talking of the savings, what impact does it have? Like increase in interest rates, what impact does it have on your money? On the other hand, we can say that okay, higher interest rates can also be positive on your savings. The increase can also cause, like, also like obviously, like maybe you got your saving maybe in bank A, and then when you started saving that money in that bank A, they were saying that 4% per annum, that's the interest you get. So which means now most probably maybe it might be on 7% or 8%, which might be also a positive thing on your savings, that whatever you're putting in, you might have higher compound interest on your investments or on your savings and on your money. So, however, it also depends with the type of interest you are earning on your savings as well. Is it simple interest? Is it compound interest? So each time when you're deciding, like, you want to save money, always choose where there is compound interest, where the money, like on your interest, also keeps on compounding instead of using the simple interest. But simple interest doesn't really add much money on your money, right? So okay, so let's move on. Now we're on slide 4. I'm gonna go on slide 5. Is it what you are also seeing on your end?
Yeah, you've been talking on slide 5 the
5.
whole time on savings. Yes.
So now I'm going on slide 6. Yeah.
Yes.
So now we're gonna move on to, okay, we said we're gonna talk of the hacks of coping up with high interest rates. So now I'm going to talk about ways to cope with this rise in interest rates. Let's say maybe you've got a vehicle finance, right? And we say that the impact of the vehicle finance is that, okay, maybe if you took your loan maybe 3 years ago and you were supposed maybe to pay installments of, let's say, 4,000, but with this increase in interest rates, now we are paying off 6,200, which is like 2,200 impact on your money, which you never really budgeted for. So what can you do with this? How can you manage so that at least you, like, obviously, like all these increases we are having on interest rates, it means it's the money we have to chip in, and we don't know where it's really coming from, because all the things remain constant and the interest rates keeps on increasing. Like, look at many companies, how many, like, if they're increasing your salaries, how, what percentage do they give you? Do they even increase your salary like 9 times, as we have seen how the interest rates have increased? Many companies, they don't do that. So which means that whatever all your expenses, they're still relying on that same income you have been using since last year. So now it also needs to come down to what can you do. So I'm going to give an example, like, okay, vehicle finance, you need to downgrade your car to a cheaper one with a cheaper installment. That is what I did personally. I did it myself. I had a much bigger car, but I downgraded it to a Hyundai i10, because one the other most important thing why I get to make that decision was that, okay, my installment was a bit higher, and also where I work, it's a bit far. I drive about 120 k's to and from work every day, so it was also impacting on my fuel, because like each week I had to use 1,200 just on fuel only, not also factoring the impact of the 2,200 extra I need to be paying on my car finance. So that's where I got to the decision of downgrading my car, and I downgraded to a cheaper car where I pay like lesser installments now, which was a great impact on my finances. Then also, since it's a smaller car, I now use like fuel of 800 rand per week, which gives me a saving of 500 rand a week, and that's 2,000 rand a month, which I'm now taking back to my money. So each time when these things happen, you need to like to have that scenario and understand, okay, there's no problem with you downgrading. Don't think of what will people say, because when it comes to your money, it has to be with you and yourself, and understand that, okay, I think this impacting interest rates is really impacting me, and if I continue like this, I'll continue being in this cycle of debt, right? Also, maybe you might feel like, okay, you don't want to downgrade your car. Maybe you're almost finishing paying it off, or you've already paid it off and all that. You can renegotiate your payments terms with your bank. You can just go to your bank and tell them that, you know what, guys, the impact I'm having on my with the increase in interest rates, now I have to pay 2,200 more, which I don't really have. Can we please maybe renegotiate my payment terms? Maybe they most banks, they are very willing to do that, because they don't want to lose you as a customer. So they might say, okay, we can reduce your installment, which can help you not to have that impact you are having of always going on negative when it comes to your finances. But when you with this decision, it also comes with its pros and its cons. The cons is that once they reduce your installment, it means your term loan is going to be extended. That means overall, like, when you pay off your interest, your principal money is going to be higher than the initial state. So you just need to do your research first before you go and do that. But if things are really tight, it's an option you can do, but just do your research and just understand, like, long term, is it beneficial or not? Do your cost benefit analysis and see what works best for you. And and also on this on the vehicle finance, if you have savings aside, and if you have savings aside, I would feel like it's better for you, like, maybe to take those savings and pay off your car finance. Let's say maybe you got savings of 50,000 and your car finance, you're left with 40,000. Rather take that 40,000 and pay off your car finance. Then you know that, okay, you've already paid off your car. So maybe let's say you're paying an installment of 3,000 to your car. Now you start building again your savings. But most times you can do your research and just see this. Most times the interest rate we get on our savings and on your loan payments, usually the savings is a bit way lesser than that. So if you've got savings which are just sitting aside, which you don't have any plan for, rather pay off your car finance and restart building your savings again. It's also another option you can do. So now I'm moving to the next slide 7. Let's say you have a mortgage, like you bought your house with the bank, and what can you do? So the increase in interest rates is a bigger impact on your monthly installments, as I've said, the example which I've said, like when it comes to your car financing, a scenario on our on my own case, like when in 2000, in 2021 on our bond we used to pay 7,600 monthly, but now because of this increase in the interest rates and everything which is happening, we now pay 9,200 monthly, and that's an increase of 1,600, which was not really on our budget. And it's something which is really impacting our income, because it's something which we never really like budgeted for. So this is what we ended up doing. We had space on our yard, and we ended up putting our bedrooms at the yard, so that at least we can put people in and we can have that extra income, which is now also acting as a beneficial for us. Like, okay, we have tenants who are also paying in rent, and that rental income is covering that gap we were feeling with increase in interest rates. So it's also something you can do if you got space. Put just invest in putting that those rooms, and you can see in the long term that can be beneficial. Also, you can also cut on costs, other costs. Obviously, you have in a house, there's also costs which comes with running your house. So maybe let's say you got a geyser, you can either maybe invest in buying a geyser blanket. A geyser blanket will make sure that your water will stay in for longer. Maybe you can just switch in on maybe 2 or 3 days of the week, then you can actually save on electricity. Then that's also reducing your electricity bill, and that money can also like help you in covering those costs of the higher interest rates. So now, okay, I think that was all the part which I wanted to talk to you about when it comes to interest rates. Now I'm gonna leave it over to Mita.
Thank you very much, Tari, for that. I think we've learned quite a lot, and our audience can also attest. I just would like to give our audience just about a few minutes to ask if they've got any questions before I can continue, so that it doesn't become sort of like an information overload. So thank you very much for that, Tari. You gave us a lot of tips, and I think we've all learned something. So for just 2 or 3 minutes, if any one of you would like to ask questions, we will open up for a question and answer session later. But if you've got a question right now that you think you don't want to forget or it's burning, you're more than welcome to ask it, or you can put it in the chat if you would like, just for 1 or 2 minutes. Okay, so if there aren't any questions, I will continue with the session. Thank you again so much to all of you for actually joining us. It really means a lot that you took out time to come in here and learn. And I really hope that you walk away with something. So I'll be continuing from where Tari left off, and hopefully you will take something with you. So I'll be talking about tracking your finances. So tracking your finances is extremely important, especially now with the cost of living at the moment. What it means to track your finance, it means you need to make sure that you know where each and every amount of money you have is going. And that could involve doing an actual budget. I don't like the word budget. I normally use the word spending plan, because budget makes it sound as if you're pinching cents and rands. So if you say spending plan, it's sort of, for me, sounds very liberating. So it means you're going to have to sit down and write down your expenses. Basically, writing down a spending plan is about knowing where your money is going, and then therefore identifying expenses that are unnecessary, or cutting down on the necessary ones, but they're just too expensive. For instance, your your DSTV subscription. Or any subscriptions that you might have that you do not use. Maybe you do have a DSTV, you also have a Netflix, you also have a Disney, and you have a whole lot of other subscriptions. So as a way to cut down on unnecessary expenses, in order to relieve some money that can either go towards paying off debt or increasing your savings, you have to write down a spending plan. So a spending plan requires you to be honest. You can't say you're going to write down how much you spend on your groceries, but you don't write down how much you spend on your coffee. You have to write down how much you spend on a monthly basis on your coffee or that snack or whatever it is you spend your money on. That way you will know where each and every cent is going, and therefore you will know where you need to start cutting down. So this way you are increasing more cash flow and creating more opportunities for wealth creation or even paying off debt. Tari mentioned something very important earlier. She said that it is more important to pay off your debt. If you do have debt, start first by paying off debt before you save, because the interest you get on your savings is not the same as the interest that you are paying off when you pay off your debt. If you've got any savings stashed somewhere, you can use that to pay off the debt that you have. Anytime you pay off an account, you relieve some money that could go on to paying extra towards another account. And we know that the more you pay extra towards any account, the more you are saving on interest. So, so basically tracking your finances requires you to sit down and write down each and everything, where your money is going. Each and every day, any amount of money you spent, you need to write it down. It sounds very boring, but it's important if you're going to survive the current economy that we are currently in. Thanks, Tab. You can move on to the next slide. So one other thing that we can also do is negotiate insurance premium. I'm sure most of us are very much aware of this, but sometimes because of the stress, the frustration of work and everything else that is life, we forget. So it's actually something that is not spoken of a lot, but you can call your car insurer and actually negotiate. Or if they're not willing to negotiate, you can call other insurers and they can give you a much lesser quote than what you're currently paying. In that way, if you don't want to leave your current insurer, you can use the other quotations to actually push your current insurer to decrease their current insurance premium that you are paying. So that is another way of decreasing your monthly expenses, and also relieving some money to try and cover the extra costs that we are incurring due to the increase in the repo rate, because that is the whole basis and the whole point to say my expenses used to be 8,000 rand on a monthly basis, but now they've gone to 10,000 rand. Where do I get the other 2,000 rand to make sure that I'm able to keep my house, I'm able to feed my family, and I'm also able to go to work and have all the other things that I need. So if you have many assets covered by the same insurer, that also can work for you, because it is leverage, it is an advantage for you, and it means it's something that you can use to negotiate a much reduced insurance premium. Guys, if you've got any questions, please feel free to stop me at any time, or you can put it in the chat box so that we can try and provide that assistance that you need. Thank you. You can move on to the next slide. Hi, Tari.
Can you see it? I've moved on.
Oh, is it? Okay,
Yeah.
It'll come up. So the next slide is mainly about thinking beyond your salary. So for a lot of us, this is a concept that sounds very impossible. This is a concept that even if I speak to my students or to my clients and I tell them we need to start thinking beyond salary, and that concept basically means that I have a salary, yes, I earn it Monday to Friday or whatever working hours I have, but how can I increase the salary? How can I multiply it so that whatever financial constraints that come, I am not overwhelmed or burdened, right? So I've got you an example or a scenario of a guy, John. He's 45 years old. He's a professional, and he's full-time employed with a steady salary. However, he also generates additional income through a rental property and a side business selling handmade crafts online. John wants to understand how these streams of income will affect his budget. So John has got a job already, he's got a steady income, but he's got other side hustles that he does, of which I think since COVID we've all learned that one stream of income doesn't really work. And I think a lot of people right now are panicking, as we saw during our icebreaker, that some people are angry, some people are nervous, some people are worried. We've got all these emotions because at some point buying a house was very cheap. The interest rates were very low and we could all afford to buy houses. But now 3 years down the line, we are all in trouble because interest rates have gone up 9 times, So now we want to know, actually we now have learned that we need to have side hustles. We need to have other streams of income. We cannot depend just on the salaries that we are actually currently earning. So now, what are the benefits of thinking beyond salary? Someone might ask and say, but already my salary is not enough. How do I start a side hustle when the salary I have is not enough? That is where your spending plan is going to come into play. Because no matter what happens, no matter what you think, whether you like it or not, believe it or not, you are going to have to make a sacrifice for you to get somewhere, for you to have changes that are going to take place within your finances. And that means if you must not pay DSTV for 1 month, use that 1,000 Rand for DSTV and go start a side hustle. If you can do beadwork, do beadwork. However, you must be able to sacrifice something that is going to help you bring in more income. Okay, you can move on to the next slide, Tari. So now John wants to find out, how do these multiple streams of income affect my budget? What will it do for me? Is it something that I want to undertake? Will it take much of my time and not benefit me in any way, or will it benefit me? So number one, a side hustle or an extra income, whatever you want to call it, number one, it will always increase your income. And whatever side hustle you choose, we always advise, let it be something that you are passionate about, number one. Number two, let it be not something that takes away most of your time. So let it be something that you can dedicate a bit of time to, and then after that it just continues to run itself or sell itself. That is the advice that one would give, to say it mustn't now take you away from your permanent job. It must just continue to work, to continue to sell itself or work itself out. Number two, it will help you in terms of your budget allocation or your spending plan. Remember, you had to cut down in order to start the business. Once that extra income comes in, your budget allocation will be better. You will no longer have to be pinching cents and rands and all of that, because there will be a little bit more that is in your budget to allocate towards increasing your savings. Therefore, you are also starting to diversify your investments or your savings as well, because you could have your normal emergency savings, you could have investments like your retirement and things like that. Number three, emergency fund. I just mentioned that. You could have an emergency fund. So people always say, but I can't have an emergency fund because I don't have the money. Then that is what a side hustle is for. That is what an extra income is actually for, to help you start things that you're unable to start. Because we all know that a salary for you, a 9 to 5 salary will never be able to cover everything. Point number four, your debt repayments. If you have debt, then obviously you will use your money to pay your debt quicker. That is what extra cash does, or a side hustle does. And that's how it would benefit you. And then last but not least, as I mentioned, savings, and investment. Earlier on, I spoke about wealth creation. Remember, as you are working and you are earning a salary, you also don't want to leave your children or your loved ones a legacy of nothing but debt and frustration. You also want to leave them with something that would benefit them for the future, whereby even if there isn't a lot of money, but at least there isn't any debt that is actually outstanding that they would be left behind to pay or acknowledge or sign stuff for. So basically, thinking beyond your salary is a concept that opens up your mind, your mentality, to the possibility of earning more than one salary. But my advice would be, whatever you choose to do, let it not require more time and continuously. Rather, it must require more time here and now as you start, but as it continues, let it be something that would actually continue to sell itself, and so forth and so on. I hope I'm clear. Do we have any questions so far from anyone? Any questions, guys? Okay, all right. You let me know if there is any. You raise your hand. Should you be saving or paying off debt? I think, as I said earlier, Tari has already touched on this, that because of interest, it is wiser if you've got debt to whatever extra cash you have to put it into the debt, because the debt that is charged on your, the interest that is charged on your debt, it's always higher than the interest that you will earn on your savings. Earlier on, I was just checking the different types of interest. I think maximum is up to 8% that you can get, and it depends on which bank you go with. But however, as Tari said, even though the repo rate increases or the interest rate increases affects your debt negatively, they do, however, affect any kind of savings that you have positively. So if you've got any retirement annuities, investments that you already have, they're doing much better because of the interest rates that are really going up. So saving money and paying off debt is both important financial goals, but which one should you prioritize? So it boils down to simple math: interest earned on savings versus interest charged on debts. But as I mentioned earlier, debt will increase your installments, and then in terms of savings, you will make more money. So the effects on both of these is actually different. If the interest charged on debt is higher than the interest you earn on savings, then pay off that debt first. You will save money in a long run. So basically, it's about sitting down and looking at your finances. How much debt do you have, and how much can you save? If you can save but you still have a lot of debt, then pay off your debt. It is extremely important, and be disciplined about it. Be committed to it, so that when the time comes and you are able to save, then at least you would have saved enough money. So you can move on to the next slide, Tari. So saving, it's not an easy thing. So that is why you must always have a goal, a financial goal, a why. I'm sure we've all heard of the word. What is your why? Why am I saving? What is my goal for saving? Your goal is the best discipline that you will have, that will help you to save, and not save this month, then use the money next month, and then save again, and then use the money next month. So when you know what you're saving for, it makes it simpler. It makes it much simpler if you're going to maybe do investments where you either put in a lump sum or you just put in money every single month. So your why is very important, guys. Let's make sure, because I know a lot of people always say, but saving is difficult, but it is important. Last but not least, finding your balance. I always train when I train people, or when I speak to my clients, I always tell them about what we call a DI ratio. So DI ratio means a debt to income ratio, meaning how much of your salary goes towards paying your debts. So the rule of thumb says that maximum percentage that goes out from your salary towards your debt should be 25%. So if it's extreme, it should be 30%. The only exception is if your debts, some of them are a house or a car in terms of installments. If you've got a car and a house that you are paying, then your DI ratio can go up to 45%. But if there's no car or house in your list of accounts, then at least 25% of your salary should be paying your accounts. Anything from 50, 60, 70 is extremely high. So the reason for that scenario, or that rule of thumb, is exactly what is happening at the moment in the country. In case interests increase, in case things happen the way that they happen, you've got enough room to move in your budget. So finding your balance is about knowing that I have reached 25% or 30%. Now it's time for me to stop applying for credit, rather pay off some and then start applying again. So we need to learn to find a balance between, okay, these are my accounts, this is my earnings, I would rather start paying